Welcome, curious minds, to another deep dive. Our mission, as always, is taking what might seem like dense financial stuff, research, notes, and distilling it.
Boiling it down to the key insights.
Exactly. Think of it as your shortcut to being genuinely well-informed. We try to find surprising facts, maybe a little humor too.
Keep things moving.
Right. And today we're tackling a fascinating, well, mystery almost. How do businesses really know where their money goes, where it comes from?
And what does it all mean for their success? And importantly, for you, the listener.
Absolutely. Our source material for this, it's incredibly rich. It's almost like a mini course packed with detailed examples, scenarios.
Yeah, it's great stuff for peeling back the layers on interpreting financial results.
It really is.
And what's truly fascinating, I think, is that understanding this isn't just for, the finance pros, the accountants, or CFOs.
No, definitely not.
It's sort of a universal language for checking a business's health, whether you're inside, making decisions, or outside, like an investor looking in. Grasping these numbers gives you a really powerful lens. You see beyond the headlines.
Totally agree. So over the next little while, we're going to unravel the key bits: income, expenses, then dive into something called shrinkage.
Ah, yes, the hidden drain.
Right, which is surprisingly impactful.
Yeah,
And we'll connect how all these pieces paint, hopefully, a complete nuanced picture of profitability.
sounds good. Where do we start?
Okay, let's kick off at the foundation. The anatomy of profit. The main document here is often called the Statement of Profit or Loss and Comprehensive Income. Bit of a mouthful.
Yeah, sometimes just P&L or income statement.
Right. Essentially, it measures financial performance over a specific time period. Its basic function, really simple: subtract expenses from income. That gives you net profit.
At bottom line.
Exactly. The primary aim of any business is maximizing that profit. Sounds straightforward, doesn't it?
Deceptively so.
Because the real nuance, as you said, is how you balance increasing income and reducing expenses.
And when we talk income, for most businesses selling physical goods manufacturers, wholesalers, retailer sales are, well, they're king,
Mm-hmm.
the primary engine.
Mm-hmm.
But, and this is crucial from our sources, it's not just about pushing more product. The real win is generating genuine increased demand.
That's the million-dollar question, isn't it? So beyond just, slashing prices, what strategies do our sources highlight for really boosting demand, not just volume?
Well, several key things come up. It starts with, okay, maybe obviously having a superior product.
Table stakes almost.
Kind of. Then staying ahead of trends, maybe even setting trends. Smart targeted advertising helps too.
Right.
But here's where it gets really interesting. The double-edged sword of discounts.
Oh, discounts. Everyone loves a sale, right? But how can they backfire?
Well, the obvious risk is that sales just don't jump enough to cover the lower price. But our sources also hint at something subtler,
Like what?
like potentially damaging the brand's value long-term,
Hmm.
or training customers to only buy when there's a sale. It's a real strategic tightrope. You might get that short-term bump, but if the unit increase isn't huge, or if it changes how people think about your product, you could actually end up worse off.
We have that wannabe rich traders example in our notes, which really nails this.
Yeah, that's a good one.
So imagine they normally make, say, our $10,000 profit a month. They try a 20% clearance sale.
Mm-hmm.
If sales only nudge up maybe 60% more units sold, their profit could actually plummet by like
Huh.
90% down to just R1,000.
Ouch.
But if that same markdown sparks a massive rush, maybe triples their unit sales.
And it works.
Exactly. Their profit could jump 50% to R15,000. It just shows the success isn't just the discount, it's the scale of the response.
Yeah, definitely. And while we're talking sales, we also need to touch on sales returns.
Right, stuff people send back.
Exactly. Maybe it's defective, poor quality, whatever. These directly reduce your total sales figure. So our 400,000 in sales, but our 10,000 in returns. Your net sales are for 390,000 for the books.
Okay, got it. So that's the income side, mainly sales. What about the money going out that's directly tied to those sales? Let's talk cost of sales.
Right. Sometimes called cost of goods sold or COGS. It's essentially the net purchase cost of the specific goods that were sold during that period.
So not the cost of everything you bought, just the cost of what went out the door.
Precisely. And the relationship is fundamental. Sales minus cost of sales equals your gross profit.
Gross profit, we'll circle back to that. But sticking with cost of sales, how do businesses shrink that number?
Good question. Maximizing that gross profit really comes down to two levers, right? increase sales revenue, which we discussed,
Hmm.
or find ways to decrease the cost of sales.
And our sources list some smart ways, negotiating better deals with suppliers, obviously,
Getting those discounts or better payment terms.
finding ways to cut transport and storage costs, maybe switching suppliers or buying in larger bulk.
And, crucially, minimizing inventory losses, things getting damaged or stolen, which, as you hinted, connects to shrinkage later on.
Right. So let's look at wannabe rich traders again. If their normal cost per unit is, say, R100,
Okay.
and they negotiate with a new supplier, get it down to R96, just 4 Rand less per unit.
Doesn't sound like much.
But even if their sales stay exactly the same, that small change boosts their net profit by, what, 20% in the example?
Wow, yeah. It really highlights that there are multiple strategic levers here. It's not just about pushing sales volume. Improving efficiency on the cost side
Mhm.
can be just as powerful, sometimes more so.
Definitely.
And maybe just a quick sidebar on VAT, value-added tax.
Oh, good point. That pops up everywhere.
Yeah, in South Africa it's 15%,
Mm-hmm.
but similar sales taxes exist globally. It's an indirect tax collected by businesses. The key thing for these calculations, for profit and markups,
Mm-hmm.
businesses almost always work with the VAT-exclusive prices. The price before tax is added.
Okay, important distinction. So net sales minus cost of sales gets us to gross profit.
Correct.
What exactly does gross signify here?
Think of gross as meaning before deductions. It's the profit purely from the buying and selling activity, before you account for all the other running costs of the business.
Like rent, salaries, that kind of stuff.
Exactly. Whereas net profit, the bottom line we mentioned earlier, is what's left after all those other expenses plus interest and tax have been deducted.
Got it. So gross profit is the first big profitability checkpoint. What comes next? The running costs.
Precisely. These are your operating expenses, often just called overheads.
These are costs like the electricity bill for the office, maybe stationery, salaries for admin staff.
That's the idea. Costs the business incurs that aren't directly tied to producing or acquiring the goods sold, and you don't expect to get the money back later, unlike maybe buying a piece of equipment you could resell.
Right. They just keep the lights on, essentially.
Pretty much. And they generally fall into 2 buckets. Marketing and selling expenses, think advertising, sales commissions,
Mm-hmm.
and general and administrative expenses, rent, utilities, office salaries, insurance.
Okay. And just to be clear, what isn't an operating expense?
Good clarification. Cost of sales is separate. Sales returns are a deduction from sales. Interest charges and taxes are also treated distinctly.
So typical examples would be things like wages, insurance, advertising, phone bills, repairs, rent, water, electricity, stationery, even bad debts.
Yes. Credit losses when customers don't pay often falls under operating expenses too.
Okay. Moving down the statement, what about interest?
Interest is basically the cost of using money, either money you've borrowed or money someone else is using of yours.
So it can be an expense or income.
Exactly. You might earn interest income from, say, letting customers pay late, interest on debtors, or from having money in savings or investments.
Okay.
And you incur interest expense when you pay interest on loans, overdrafts, maybe even late payments to the tax authorities. It has to be accounted for before you get to that final net profit figure.
And does it make a big difference?
It certainly can. Our example 2.3, Want to Be Rich Again, shows them taking a $200,000 loan. At 15% interest for 8 months, that's $20,000 in interest expense.
Wow.
That's $20,000 straight off the profit before tax. Shows how borrowing costs can really bite.
No kidding. Okay, almost there. The final hurdle before true net profit.
Taxes, income tax.
Right. Just like individuals, businesses pay tax. In South Africa, it's to SARS.
Correct. Our sources state that closed corporations and companies in SA pay tax at, currently, 28% on their net profits.
And that's net profit after all those other deductions we just talked
Yeah.
about.
After everything else is accounted for. The Uring Ltd example shows it clearly. Profit before tax of R280,000 means a tax bill of R78,400. That's 28%.
So income tax really is the final step in figuring out what the business actually gets to keep.
It is. The ultimate bottom line is profit after tax.
Okay, so we've tracked the money in through sales, deducted the cost of goods, subtracted operating expenses, accounted for interest, and paid the tax man. Feels like we should have our final number right.
You'd think so. But there's this other factor, this kind of silent drain you mentioned earlier.
The money that just seems to, well, vanish.
Exactly. And the accounting term for this is shrinkage.
Shrinkage. It sounds almost trivial, but you implied it's a bigger deal.
It can be, yeah. It's the loss of gross profit from a whole mix of things.
Hmm.
Employee theft is a big one, often the main cause globally. according to our sources, but also shoplifting, simple breakages,
Okay.
inventory getting old or obsolete, problems with stock rotation, even admin errors or natural disasters. It all adds up.
Wow, okay, that's a wider net than I thought. It's not just theft.
Not at all.
Our sources break down these causes quite well. So theft, obviously inventory stolen, totally lost, reduces gross margin directly, like clothes nicked by staff or customers.
Mhm.
Then breakages. A fragile item dropped, can't be sold, written off. Think antique vases.
Right. Instant loss.
Aging inventory, old stock needing heavy discounts, or becoming worthless. Fashion is a classic example.
Last season styles.
Similar issue with obsolete inventory stock that's just outdated. Old tech, maybe? Poor inventory turnover is interesting too. Stock sits too long, tying up cash, maybe spoiling if it's perishable. Like groceries not rotated properly.
Yeah, first in, first out is crucial there.
And even literal shrinking, like compost losing volume in bad weather. And finally, big events like natural disasters, fires, floods causing massive, unavoidable shrinkage.
What's really striking when you list them like that
Mm.
is how many are actually internal issues.
True, not just external crime.
It really points to the importance of good management, good systems, good controls. Preventable losses in many cases.
So how do businesses minimize this? What are the countermeasures?
Well, general methods include things like boosting security. CCTV is common.
Cameras everywhere these days.
Yeah, but maybe more fundamentally, keeping really accurate records of every single inventory movement, tracking everything, plus having secure storage and just double-checking orders before they go out to customers, ensuring the right stuff goes to the right place.
Makes sense. What about shoplifting specifically? Any targeted tactics?
Our sources suggest things like placing high-risk, easy-to-steal items in really visible spots, maybe near checkouts.
Yeah.
Using warning signs, making sure aisles aren't cluttered, shelves are neat, makes it harder to conceal items. Training staff is key, teaching them what to look for. Even just asking customers for feedback, where could someone steal from easily, can highlight vulnerabilities.
Yeah.
Basically, being attentive.
And you mentioned accurate records being vital. How does that work in practice?
It starts right when goods arrive, logging everything received, checking the condition.
Control.
Exactly. Comparing delivery notes to the original purchase order, unpacking carefully, counting items, quantity check, visual inspection for damage. It's methodical.
Seems like a lot of checking.
It has to be, to control shrinkage effectively.
Right.
And this ties into the inventory systems businesses use.
Ah, right. There are different ways to track stock.
Two main ones discussed in our material. First, the perpetual inventory system.
Perpetual, meaning continuous.
Exactly. It provides continuous updating of inventory balances. Every sale, every purchase, the system knows. Cost of sales is always known, so gross margin can be checked anytime.
How does that work technically?
Think barcode scanners. That magic eye instantly updates the record when an item is sold. The system can even flag low stock levels automatically for reordering. It's very real time.
Okay, that sounds pretty efficient. What's the alternative?
The periodic inventory system. Here, you don't track outflows in the point of sale.
So, how do you know what you sold?
You figure it out periodically, usually at the end of the financial year, by doing a physical stock take.
Ah, okay.
The calculation is opening inventory plus all your purchases and related costs, like shipping, minus the closing inventory you counted in the stock take. The difference must be your cost of sales.
So stock takes are essential for the periodic system. Are they needed for perpetual too, if it's tracking everything?
Absolutely vital. That's a key insight. Even with a perpetual system updating constantly, you still need physical counts.
Why is that? To catch errors.
Errors, yes, but primarily to uncover shrinkage. The system thinks it knows what should be there based on records. The physical count tells you what's actually there. The difference, that's your shrinkage due to damage, obsolescence, theft.
The stuff that vanished between the records and reality.
Precisely. The Zenith dealers example nails this. Their system estimated R90,000 of inventory.
Okay.
The physical count found only R88,000. That R2,000 difference isn't just waved away.
No.
No, it's recorded as an expense, usually hitting the cost of sales account, as per accounting standards like IFRS. It directly reduces their profit.
So the physical check is the ultimate truth test. It reveals the real impact of shrinkage.
Exactly. The numbers on the screen versus the reality on the shelf often tells a much deeper story.
Wow. Okay, so wrapping this up then, this deep dive has really shown, I think, how looking beyond just the headline profit number is crucial.
Definitely.
Understanding each bit, sales, cost of sales, operating expenses, interest, tax, and then factoring in that often hidden but potentially significant impact of shrinkage. It gives you a much more complete and nuanced view of how a business is really doing financially.
And what this means for you, the listener, is you now have better tools, a better framework to critically evaluate a company, its health, its strategies, maybe even its weak spots.
Right.
You can start to see why the numbers are what they are. It's about developing that sharper eye for what truly drives profit or what might be subtly eating away at it.
Seeing the story behind the numbers, as you said earlier.
Exactly.
So, a final thought for everyone listening. The next time you glance at a company's results, or maybe even just see a big clearance sale, think about these layers we've uncovered.
The discounts, the costs, the potential shrinkage.
How might understanding these dynamics change how you look at the world of commerce? And maybe, where else could these principles of tracking income, expenses, and hidden losses apply? Perhaps even closer to home.